Silver just ripped back above $93 in the West, while Shanghai is paying over $105, and that gap is no longer a curiosity, it's a signature of a system that's starting to break. This is financial warfare education in OG John A.G. style. No signals, no VIP, no hopium. I'm going to walk you through exactly what a $12 overnight Shanghai premium means, how 1.2 million ounces just bled out of COMEX, why more than 52 million ounces are already standing for March delivery, and why the glitch on CME was anything but random. By the end of this video, you'll see why the real price of silver is being set in Asia, not on your Western screen. Segment 1, the overnight explosion in the Shanghai premium. As I'm recording this, here are the live numbers. Western spot silver is trading around 93.58. Western front month futures are basically at the same level, about 93.58s. Shanghai spot on the SGE SHFE benchmark is around $105.82. Shanghai futures are pushing even higher. That's a 12.24 premium, roughly 13% above the Western paper price. That is not normal arbitrage. That is not some little Asia-like silver move. That is the largest east-west divergence we've seen in years, and it's widening overnight while COMEX vaults are bleeding metal. When one part of the world pays $93 and another is happy to pay 105 pluses for the exact same ounce, you are not looking at a free, unified global market. You're looking at two different realities trying to occupy the same chart. Segment 2, what COMEX actually has left now, let's talk about the metal that supposedly backs the Western price. COMEX tracks its silver inventory in two main buckets. Eligible, silver that meets COMEX specs and sits in approved vaults, but belongs to private owners and is not designated to satisfy futures delivery. Registered, silver that has a warehouse warrant attached and is available right now to back a futures contract that stands for delivery. According to the latest CME Daily Silver Stocks report, registered silver is down to about 86.13 million ounces. In the last 24 hours alone, around 152,000 ounces were withdrawn from registered. Total COMEX silver stocks fell by about 1.21 million ounces in that same 24-hour window. That isn't a slow drip. That's a short hose in a very shallow pool. You can play games with paper all day, but when registered keeps stepping down, 86 million, 85, 84, you're watching the actual ceiling of how much metal COMEX can hand over if people demand bars instead of dollars. Segment 3. March 1st notice day. Who is actually standing for metal? Here's where it gets serious. Today is effectively March 1st notice day. That's the point where longs in the front month contract decide whether they're going to roll, close, or stand for delivery. The numbers? Over 10,000 contracts are already standing for delivery. Each silver contract represents 5,000 ounces. That's more than 52 million ounces claimed on day one. Now line that up against the 86.13 million ounces in registered. More than 60% of the remaining deliverable silver on COMEX has already been spoken for on the first day of the delivery period. You don't need a PhD to see the tension. Around 86 million ounces in the deliverable bucket. The first wave alone is over 52 million. The month hasn't even fully unfolded yet. If this pace continues, COMEX has to either convince big eligible holders to flip their metal into registered at higher prices, lean on cash settlements and quiet deals, or watch that registered number fall to levels that spook everyone watching the vault reports. Segment 4, why the arbitrage is ripping metal out of New York. Let's talk about why those COMEX inventories are falling so fast. With Shanghai paying 105 plus and COMEX pricing around $93, the arbitrage window is huge. Rough math. Shanghai pays about $12 more per ounce. Shipping and insurance from New York to Asia might cost around $2 per ounce. The spread doesn't just cover costs, it pays a serious profit for anyone able to move size. So what happens? Metal gets pulled out of New York. It gets shipped east. The arbitrage gets closed not by paper contracts, but by bars leaving Western vaults. Every ounce that leaves COMEX registered to capture that premium makes the next delivery cycle harder. The more Asia refuses the Western paper price, the more the physical flows, and the more visible the structural shortage becomes. This is not metal's casino fun. This is a textbook example of how a broken paper price gets arbitraged against a real physical bid until the exchange's inventory is dangerously thin. Segment 5, the CME halt and the manipulation footprint. Now, none of this is happening in a vacuum. Go back to February 25th. Silver was pushing into the $91 breakout zone on the way up. Right at that moment, CME Globex halted metals trading, officially due to technical issues. During the halt, data shows around 31,128 silver contracts traded. That's about 159 million ounces of paper equivalent, while the market was supposedly frozen. Read that again. Officially halted. No normal access for most participants. Yet volume kept printing. Tens of thousands of contracts, hundreds of millions of ounces in notional terms. That's not a little glitch. That's a window where the biggest players can reposition while everyone else stares at a frozen screen. When trading fully resumed for the public, price was driven hard lower. Stops were cleaned out, the breakout structure was broken. And now with that event in the rearview mirror and a hotter than expected PPI print giving the algos fundamental cover, silver is right back up in the low 90s, with Shanghai still paying in triple digits. The tape says paper was used to smack the price during a convenient failure. Physical reality never agreed with that message. Segment 6, the PPI excuse and the currency story. The macro excuse was simple. US PPI for January came in at 0.5% month over month, above the 0.3% expectation. Core PPI was also hotter. Headline: wholesale inflation reaccelerates. Perfect narrative for machines. Stronger economy. Higher for longer. Sell metals. Buy dollar. Except the physical market didn't care. Shanghai kept bidding. COMEX kept bleeding. The $12 premium held and expanded. This is the bigger signal. Silver isn't just some speculative playground trade anymore. It's a currency stress gauge. These violent upside moves in gold and silver are not the mania of metals. They're the symptoms of a fiat system that's been abused since 1971 and is now in visible dysfunction. From the mid-1970s to now, governments chose more debt, more monetization, more weaponization of currencies. You get away with that for a while, then you don't. When the math breaks, the adjustment is not gentle. It's sudden, it's chaotic, and it shows up exactly where we're seeing it now, in the arbitrage between fake paper prices and real physical bids. Segment 7, why Asia is willing to pay 15 plus over COMEX. Asia isn't buying silver at these levels because it's bored. China, India, and the broader East need silver for solar panels, electric vehicles, defense and dual-use tech, data centers and AI hardware, consumer electronics. When they pay a double-digit premium over the Western spot price, they are not speculating on a chart. They're securing feedstock. They know Western paper markets are overlevered. COMEX is running down its deliverable stock. The long-term structural deficit in silver means replacement will be slower and more expensive. So they make a rational decision. We'll pay 12 to 15 on more now, because we can't trust that the West will offer real metal at these prices later. The fact that the arbitrage is now big enough to pay for shipping several times over tells you how distorted the Western price is. Segment 8, the structural deficit, India, China, and the 6th-year zoom out from the last 24 hours. We are now in roughly the 6th consecutive year of a structural silver deficit. Global demand has outpaced mine supply plus recycling for years. India has been importing a staggering share of annual mine supply. Some estimates put it around a quarter of world output in recent years. China entered backwardation in silver before its New Year holiday and is now reopening into a massive premium. At the same time, the U.S. has quietly added silver to the list of critical minerals for national security, especially for AI, defense, and high-tech manufacturing. The military-industrial complex is consuming silver at rates not seen in decades. All of that is happening while COMEX registered sits in the mid-80 million ounce range and keeps drifting lower. You don't need to believe in a grand conspiracy to see what that means. A structurally tight market, a key pricing venue bleeding inventory, two of the biggest physical buyers on Earth, China and India, willing to pay above Western paper prices and decouple from London benchmarks. Segment 9, the honest bear case. Being bullish doesn't mean ignoring risk. Here's the realistic bear case. Silver has had violent moves up, it can have equally violent moves down. March contracts can still roll or cash settle. Not every open interest number turns into delivery. Another hot inflation print or policy shift can give algos fresh ammo to slam price during thin liquidity. COMEX has managed delivery pressure for decades using rollovers, cash settlements, and quiet enforcement. They've played this game before. Technically, a clean break and close below key levels like $91.50 could open up a retest of the high 80s and even lower in a fast washout. All of that can happen. None of it. Refills COMEX vaults once metal has left, cancels 6 years of deficits, reverses India's and China's shift toward treating silver as strategic. Short-term price paths can be all over the place. Long-term structural math is what it is. Segment 10, what the full picture actually shows. Put all the data on one screen. Shanghai premium, 12.24 and expanding overnight. COMEX registered 86.13 million ounces, drifting lower. Last 24 hours, 1.21 million ounces drained from total COMEX stocks, 152,000 from registered alone. March 1st notice, 52 plus million ounces already standing for delivery. CME halt, 31,828 contracts, 159 million ounces, traded while metals were frozen, then a $6 slam. PPI, Hotter print used as the perfect macro excuse for algos to hit metals while physical refused to follow. The arbitrage is now draining vaults in real time. The east-west divergence is the clearest it's been in years. Price discovery is quietly shifting east, one truckload of bars at a time. You do not need to front-run every candle. You do need to understand why Asia is paying more, why COMEX stocks are falling, why more and more contracts are standing for delivery instead of rolling. This is financial warfare education, not investment advice. Size your positions as if you can be wrong. Use logic, not hype. Because when silver is finally allowed to trade purely on physical supply and demand, without an army of paper contracts sitting on top of a draining pile of metal, the move isn't going to be interesting. It's going to be explosive.